Ladies and gentlemen, good day and welcome to the Bajaj Electricals Limited Q3 FY21 earnings conference call hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. I now hand the conference over to Mr. Deepak Agarwal from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thanks. On behalf of PhillipCapital to Q3 FY21 earnings call of BAJAJ Electricals Limited. From the management today, we have with us Mr. Anuj Poddar, Executive Director, Mr. Anand Purandare, CFO, and Mr. E.C. Prasad, Deputy CFO. We would like to thank management for giving us the opportunity to host this call. Now we'll hand the floor to the management for their opening remarks. Post which we will open the floor for Q&A. Over to you, sir. Thanks.
Thank you, Deepak. Am I audible?
Yes, sir, you are.
Yes, sir, you're audible.
Great, thanks. Good afternoon, everybody. This is Anuj Poddar, and welcome to our investor call. Firstly, I hope all of you are pleased with the results. It is another second very strong quarter that we've delivered on. It is the highest ever profits for our consumer products business and also the highest ever PBT and PAT as a company that we've delivered on. While before I get into the number details, if the numbers are all known to you, I just want to say that it's not just the total numbers or the absolute numbers, which is why I'm pleased, but actually the composition of those numbers and the underlying message from those numbers. I think the composition point that I want to make is that it is secular performance on all parameters, whether operating or financial performance. So it's operating or financial parameters across every element. The performance has been good, and I will talk about that a little more. And it's also representative of what I call the new Bajaj Electricals. I've been sharing this for a while that we are on a transformation journey. We are doing many internal things, and I think the fact that we are now truly here, truly able to deliver, truly able to execute well, and play to our strategy. I think that's the underlying message that I want to highlight from the numbers and the financial performance that you're seeing. Just quick headlines on the numbers, you've all seen that, but our top line growth at a company level is strong at 17%, clearly powered by our CP growth at 34%. Like I've been maintaining, we intend to deliver higher bottom line growth than the top line growth continually, and therefore seeing the average play out. Our margin expansion on CP has been very sharp and strong this quarter, but the margin expansion which has happened from 7% to 12.3% is a combination of operating leverage and the internal changes and improvements in efficiency that we're working on. So while the operating leverage may be a bonus because of buoyancy in demand, but I think the underlying efficiencies and improvements that we're bringing in are here to stay. So some of that will clearly sustain into the future. Beyond that, all the improvements on the balance sheet are now starting to play out very strongly in the P&L. You're seeing the reduction in the finance cost and therefore the step up on the PBT and PAT level also. The other big piece, which is our EPC segment, while on the top line that is come down, that is part of the calibrated strategy. I think important is that we continue to reduce our losses. It's a single digit loss for the quarter. It is much lower than last year. So despite a lower top line, we've cut back costs much more sharply in that business, and therefore are able to control the losses to a significant level, where we are now at a level where I think, the loss from that EPC business is not necessarily a huge drag for us as a company as a whole. It is something very, very easily able to manage on a consolidated basis. So that's the P&L view. I think the other headlines for us is the cash flow. The cash flow continues to be strong. We've delivered 142 crores of cash from operations in this quarter. And like always, bulk of that is being used to reduce our debt levels. Our debt levels are down from 550 plus crores in September to about 440 crores or 441 crores now in December. So our debt levels quarter on quarter have continued to reduce, and our balance sheet has become much healthier. Our ratios are all looking healthy. So that's the overall financial performance. I will just again end with headlining the fact that it's a secular growth or improvement on all parameters. And more importantly for us as management, it's the internal systems, internal working, internal execution excellence that is most heartening for us, and that is here to stay. And that's really what we're betting on for the future. So with that, I'll pass it on back to yourselves.
Shall we open up for Q&A, sir?
Yes, please.
Sure. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star, then 1. The first question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah, hi, good evening team, and congratulations for the very strong performance coming back on board. So my first question would be to understand a bit more on the consumer side of the business. If you can throw some inputs in terms of individual segment-wise, which businesses led growth, and where did we see the market share gain coming through? And aligned with this, in terms of margins for the consumer business, though there would be input cost headwinds, should it be fair enough to assume that if we continue to grow the business, we should now be reasonably able to sustain the double-digit margin profile in consumer business?
So, Renu, thank you. Good afternoon. On the first part, the segment growth, so CP overall is 34%. Within that, our subcategories, our appliances has grown at about 36+%. Our fans has grown at 22%. Lighting has grown at 18%. And the good news here is our Morphe Richards, which had been dormant for a while, has grown at 69+% in this quarter.
Wow.
So it's a growth across all the categories. And this is what I was referring to in my opening remarks. It's the underlying metrics. A dormant business such as Morphe is finally showing great traction. And this is the second quarter back to back, and we are, driving growth there. In terms of market share, quite frankly, it's data that's hard for us to put out there. But I think the top 3-4 players, including us, have gained market share at the cost of all the rest of the players in the rest of the market. I'm aware that many of our competitors also have declared similar top-line growth, but I think these are 3, 4, 5 players that have declared such top-line growth. I do not believe that industry or total aggregate consumer demand for our category has grown at that level, and we are clearly ahead of the average growth of the industry as a whole. In terms of margins, we've expanded our margins sharply, from 7.7% last year Q3 to 12.3%. As I said in my opening remarks, that's a combination of internal measures and the operating leverage that we've earned. How much of that will sustain? Hard to put a number, but I do think a fair amount of that should sustain going forward also, because a lot of the improvements that we've done or efficiencies that we brought in and some of the costs that we've cut this year, we're not going to go back to 100% of that, though some of it will come back. Again, the good news there is advertisement cost. We brought it back up, brought it back in Q3 itself. So some of that which we had cut very sharply in Q1, Q2 is actually built into these numbers. Employee costs, and we can talk about that later. You've seen a good correction in employee costs, though we will have we have taken an increment from Jan. So you will see a little increase in employee costs in Q4. The only other element that I would talk about there is the commodity pricing. As we all know, commodity prices have gone up. That's happened really from December, so it's only about 1 month of that baked into these numbers. But that said, we've also taken a price hike from Jan 1. So I think the price hike should partly, if not significantly, offset the price hike or cost side price hike on the commodities. So that's where we are. The only thing we are waiting to see is how does the market trend from here on. But overall, we have a fairly optimistic view going forward.
Right. And on the consumer business, if you look at from a long-term perspective, what are the type of investments that we're doing in terms of new products, R&D or distribution, to make sure that the kind of market share growth and so-called semi-premiumization that has been trying to drive continues and sustains for the next 2 to 3 years as well?
So as I've said in the past, we are not going to be very short-term. We are playing for the long term and to drive, continuous growth over the long term. 2 of the areas that I flagged off earlier that we will invest in is products, which is R&D, and brand. Brand, you've already started to see a step up in investment, except for the COVID quarters. And R&D product investment will continue. But these are investments that we can absorb comfortably in the P&L. These are not large capex nature investments that we intend to do. But just make sure that the margins or additional profits that we're generating, we keep reinvesting that into the future. At the same time, we're committed to continue to expand our margins. So my view is these investments should not come at the cost of margin, but we should be able to deliver growth as well as margin expansion while building for the future.
Sure. And if I can ask one last question on the EPC business, can you share some more inputs with respect to the balance sheet, as in the working capital and the receivables? How do the equations stack up there in terms of pending receivables and retention money?
Sure. So I'll bring in our CFO Purandre there. Just the headline there, Q1, Q2, I know we had lower collections. Some of that has improved. Q3, our receivables have come down. Collections have improved, but let Mr. Purandre give you the numbers.
Yeah, EPC receivables has come down to around 1,600 crores, which was as of March 1,976 crores.
Sorry, sir, your voice is not very clearly audible. It's come down to 600 crores.
1,597 precisely.
Sure. Got it. And of this, what proportion would be receivables and related to the UP project?
UP project is around 730 or 740 crores.
Got it. Okay, sir. Thank you so much. Thank you and all the best.
Thank you.
Thank you. Participants, to ask a question, please press star, then 1. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Thanks for taking my question. The question is basically, the way you guided about the debt. You think now is where we can do further reduction in the overall debt numbers, or it will be more led by when we will receive the cash from the UP receivables, then only we will reduce the debt part? That's my first question. And second, given the commodity cost increase, though you said that these margins are sustainable, fairly amount of is sustainable because of the let's say the market share increase or a demand you are seeing so far. But generally, in your sense, what's the commodity impact you are building in for your Q4? Those are the two questions. Thank you.
Thank you. So on the first question, debt, we have been reducing debt every quarter. We do expect to reduce debt in Q4 also. And yes, the EPC collections will be a part of that, and we will drive that. So it will be driven by both UP or EPC collections as well as consumer products. We will maintain that. Having said that, will the debt reduce by similar 100 crores or more or less in Q4? A little early to say. Only thing to keep in mind is Q4 is a period, or by March is when you stock up for summer. So to that extent, your working capital in consumer products in inventory does go up. So we will, make sure that we are not, we are making sure that we are funding that effectively. But that's an intentional thing. Other than that, we do intend to maintain the trajectory of collections and cash flow and debt reduction. In terms of commodity prices, like I said, we've taken a price hike from 1st of Jan. The price hike across categories varies between 5 to 8 to 9%. We think that should offset a significant part of the cost side price hike for us in the commodities. We do carry some inventories from the past which are not therefore entirely affected by the price hike, and therefore we're looking to see how we can offset a large part of that price hike while maintaining margins. The only aspect to factor in is the demand side and what happens there, and therefore the operating leverage impact. But other than that, I think we're well covered for the price hike as well as general efficiencies kicking in and being sustained.
Is it right to say that the secondary sales would be some percentage point lesser than your wholesale growth, or if you can throw some color on your secondary sales so that, you give a little perspective on the inventory position, what your channel is?
So not for us, and I think that distinguishes us a little bit from, the rest of the industry, where because we work on the replenishment model in the RREP and TOC, we do not have aggressive primary sales. And I know at this point, because price hike was imminent, a lot of the market has resorted to a lot of, extra stocking by distributors, etc. That's not the model we have. So our secondary sales is pretty much bang on and consistent with our primary sales, even in this period, in this quarter in December month.
Great, sir. Great to know that. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, good evening. Congratulations for the great numbers. My first question was, with respect to the cost control, you said, certain cost measures have also improved the margins. So can you elaborate? Would it be possible for you to elaborate a bit on these cost reductions? What the nature of the cost reductions are?
So it's a mix of many items, Achal. One is at the COGS or supply chain level. If we keep aside the whole commodity price increase, in general, we're yet working on making our supply chain sourcing and COGS more efficient. We've done that in this quarter also. Number two, our logistics cost is something that we're working on. Number three is the overheads overall. Overheads includes things like employee cost, operational cost, office costs, etc. So across the primary costs, which is COGS and logistics, as well as secondary costs such as overheads. So each of these line items we've been aggressively targeting and cutting back on. Or by cutting back, I don't mean artificial cutting back, but actually more structural cutbacks that makes it more efficient and sustainable.
And with respect to the cost reductions, what we were talking about probably 3 or 4 quarters ago with respect to, scale down of the EPC business, where have we reached on that? Have we crossed, 60-70% of that execution, or it is still much below than that?
So my EPC guidance has been last time also that 2 quarters into next year is when we should be then turning around after that. I maintain that guidance. But it's not, that's in terms of turnaround on profitability. But important is the absolute number of the loss. Like you see this quarter, the loss number is very small. So hopefully even before we turn profitable, the loss number itself should be something that, no longer we are very concerned about or worried about. But more importantly, EPC, we're driving also from the working capital or capital employed or receivables metric. And that is important to keep generating cash over there rather than, just looking at the P&L side on the EPC. Yeah.
So is it fair to say that the losses will be, for next 2 quarters will not be as large as what we have seen in probably in the similar range what we have had in third quarter? Would that be a fair assumption to work with?
I can't give a number guidance, Anshul, unfortunately, but it should not be something that now shakes up P&L, consolidated P&L at all.
Understood. And just last question, if I may, with respect to, some of these market share gains is also driven by the supply disruptions for the others. In terms of the competition, are those supply chains normalized? Have you seen the smaller guys also coming back? And how sustainable these market share gains are? Why I'm asking is basically the numbers are fabulous, upwards of 30% for most of the leading guys. While as you indicated that the market growth isn't as significant. So what is the kind of number, I know it's hard to say for the company, but at the industry aggregate level, what kind of growth do you see for the categories we are in?
Let me answer the first part in terms of, do you see the other people come back? I think we're at least 2 to 3 quarters away before things normalize when it's normal. So we're all delivering growth despite multiple challenges. The supply side challenges have persisted through all of this financial year, and it has persisted in Q3 also, but the nature of those supply side challenges changed. I think during lockdown and otherwise, supply challenges purely in terms of inventory levels and manufacturing capacity. That has changed subsequently to China imports. Subsequently, it's changed to containers. Now the latest set of supply side challenges is pure logistics, transport, truck availability, movement, warehousing, in parts of India, etc. So, and the reason I'm highlighting that is that, our growth is despite that and not constrained by that. But for everybody, particularly the long tail, to actually deal with these challenges is not easy. And I don't see some of these things normalizing even over the next 3 to 6 months at least. So I think we do have, for better or worse, as long as we're able to deal with these effectively like we've been doing, I think we shall continue to maintain and defend our enhanced market share at least for another couple of quarters. And quite frankly, if you do that for that period of time, you do start becoming more and more entrenched, and that becomes more and more harder to then shake off after that.
This is great, sir. Very helpful. Thank you so much.
Thank you.
Wish you all the best.
Thank you.
Thank you. The next question is from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, good afternoon, team, and congrats for a great set of performance. My first question is on the receivables of about 1,600 crores, which you highlighted on the EPC side. So I just wanted to understand this better in terms of where do we expect this number to sort of reduce as we sort of enter FY22, and how much of this could have been provided in the P&L?
So, Bhargav, hi, good afternoon, thank you. Just first, let me give you the numbers more specifically. So, as of September 20, the total EPC receivables was 1721 crores. As of December, that is 1597 crores. It's about 125 or 24 crores reduction. Of that, PD is 1097 crores. Your power transmission is 353 crores. And illumination is about 147 crores. Okay, that's the breakup of that. So if you see, the maximum reduction really has happened in the PD or power distribution business. And this is an improvement over the previous couple of quarters where we are not seeing reduction on that side of the business. Okay, I do believe Q4 collections also should be stronger than Q3 collections, but let's see. But that's my estimate at this point of time. I don't know if you mentioned by end of FY22 was your question?
Yeah.
So again, I can't give a number guidance, but like we've discussed in the past on the calls, we do expect significant collections to come in over the next, within the next fiscal, and you will see a much lower number like we've been guiding without me giving you a specific number on that. Yeah. There will be retention monies some of that will continue post that, but most of the non-retention money should be collected within next fiscal year.
No, so I hope there are no negative surprises in terms of write-offs, because this is a huge sum. So
that was a P&L question, Bhargav. In our estimate, we are fully provided for. Otherwise, auditors would not have passed for that. So we are adequately and fully provided as far as we are concerned.
Okay. Secondly, sir.
I'd like to just make one correction that UP outstanding is 690 crores. It's not 740. It is 690 crores.
Okay, understood. Secondly, you mentioned that you have stepped up your ad spend. So is it possible to quantify what was the ad spend as a percentage of revenue this quarter and what was it same quarter last year?
Yes, sure. So it was 35 crores in last year Q3 at 2.8%. This quarter it is 45 crores at about 3.9%.
Oh, wow. So essentially there's a significant jump in ad spends on a YOY basis.
Yeah, and that's the point I was making. So that is already baked into the numbers.
Okay. So is it possible to highlight what has been the gross margin improvement on the consumer business? Is it possible to quantify that?
Gross, we don't share, Mr. Purandare, right?
No, we don't share because obviously it is lighting is different, appliances, fan, they have different gross margin.
Sure.
We don't.
But let me just tell you that it is improved.
Okay. And is it fair to say large part of the EBIT margin improvement would be operating leverage or driven by gross margin improvement?
No, so all three. One is gross margin improvement. Second is operating leverage. Third is, I would yet split operating leverage in terms of because of volume versus actual improvements in the operating costs or overheads. So even if we didn't have operating leverage, we would have had gross margin improvement and operating margin expansion because of overhead efficiency that we've brought about. So I would put that in three buckets there.
Okay, and the last question is, you mentioned appliances growth has been 36%.
Yes.
Is it fair to split this into water heaters and kitchen appliances?
No, we don't split that up.
Okay, because a lot of kitchen appliances...
But both have grown very strongly, so let me tell you that.
So because kitchen appliances companies haven't registered such a stellar growth, so I was wondering whether it's driven by water heaters or...
No, so both have. Though to my knowledge, other kitchen appliances also have registered good growth, but anyway, to answer for ourselves, it is across kitchen and water heaters.
Okay. Great, sir, and all the very best.
And just, if I may say that again, that's why my opening comments, that why I find it satisfying that it is not lopsided performance driven by something, but it's fairly secular performance on almost all, operating dimensions that I see here.
Okay, great, sir, and all the very best.
Thank you, Bhargav.
Thank you. The next question is from the line of Manish Santalia from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity, sir, and congrats on great set of numbers.
Mr. Santalia, your voice is not clear to us, sir. Can you please use your handset?
Yeah, is it better now?
Yes, sir. Thank you.
Okay, so thanks for the opportunity and great set of numbers. Congrats on that. Just have a strategic question. What are you going to do with the EPC business after you execute this 1,200 crores of orders? I mean, is it a continuing business or you're going to stop bidding for projects? Because obviously the quality of business is not that great with a huge amount of receivables and EBIT margins also in the negative terrain, and you really don't know when the state governments are going to pay you money. So what's the strategy on the EPC side? Is it going to be a continuing business or whether you'll discontinue it?
So Manish, I'd like to split up your question into two different parts in terms of the business going forward and the legacy receivables. And I don't think the legacy receivables are a function of the future business.
Yeah. Okay. Yeah.
Let me answer the legacy receivables part first. Of course, we are collecting that and cleaning up. And, while timing we cannot predict because it's not in our control, we are aggressively working on that, and we will keep seeing quarter-on-quarter improvement, and you will see significant annual improvement. That's my commitment to you. Okay. So that will get cleaned up without too much hit or without any hit, hopefully, on the P&L. On the continuing of future strategy on EPC, I've maintained in the past that, we have intentionally descaled that and calibrated that purely from a capital employment perspective into that business and the total quantum of risk that we wish to take on that business. I think today at a revenue level, we are at a revenue level of the EPC business at which we are comfortable. If you look at Q3, I think EPC is about 25% of our P&L. Now, the thing that we're working on, so from here, I don't see the need to descale in absolute terms the EPC business, but what we are changing is the composition of that EPC business. So whether that includes the illumination business is also reported in that. That is something that we will continue to drive growth on. It also includes a transmission business that is fairly healthy. We will hold that business, and includes a distribution business, which is the one that is most challenged. And unless we see compelling orders or profitable orders, we are being very careful on taking that part of the business. So net going forward, EPC business at a revenue level may sustain at these absolute aggregate numbers, but the composition of that will be much healthier at the top line or even in terms of product or business mix. And at the bottom line level, you will see a healthy, profitable business on the EPC also, even on these numbers. So that's the future business. The balance sheet cleanup we'll continue to see, and that will deliver improvements for you.
Okay, so which means that power distribution is not what you're going to be, too gung-ho about, but the rest of it will continue.
Yeah, and my view on power distribution also, if something changes dramatically tomorrow, why not? But to me, we are a businessman, we have capital, we have alternative uses of that capital. So unless I see a compelling tender, compelling margin, and not just tender and margin, but the risk covered, payment risk covered, we have alternative uses of our people and our capital.
Sure. Thanks.
Thank you.
Thank you. The next question is from the line of Akshay Bhor from Premji Invest. Please go ahead.
Hi, am I audible?
Yes, Akshay.
Hi. Thanks for the opportunity. Just a couple of questions.
Sorry, you've gone faint again.
Hey, can you hear me now?
Yes.
Okay, so a couple of questions from my side. First one, just want to understand in terms of product strategy from here on, are there any white spaces, within the existing portfolio, or there are newer opportunities that you see from a 2-year perspective that you're looking at?
Akshay, like you said, white spaces, we're not looking at it across into newer categories, but focus on our categories because we believe there's enough room to grow in the existing categories. In the existing categories, it's a mix of white spaces versus improvising our product offerings. White spaces, there is a clear white space, for example, in premium fans. We've traditionally been very weak in that part. We have already launched products, but it's yet a relative white space in terms of our presence in that, segment of the fans category. And overall fans as a category is something that we lag in. So clearly fans as an overall category is something that we're focused on driving growth for. Similarly, in some of the other product categories, I would not say absolute white space, but our trajectory will be more towards premiumization because, our anchor point is on the median or lower median, and therefore we do want to improve our anchor point of offerings upwards on many of these product categories. But I don't think they're absolute white spaces. We're absolutely virgin where we're not present. But there is enough scope for us to have better offerings and better range of offerings and more compelling contemporary products there. So that's the way we're working on. I think the more important strategy for us is faster churn of products. So that's what R&D is working on in terms of number of SKUs that we launch every year and have a much faster churn of products and offerings in the marketplace for the consumer to choose from.
Okay, great. Just want to understand on the EPC side, how big is this B2B lighting, which you call as illumination, that sits there, and what's the size of that, either in terms of F20 or this year 9 months, and what is the kind of margins that you make on that? I mean, if you can share any indicative number rather than.
Sure. So we can give you a number. Illumination traditionally is between 600 to 700 crores. Had this been a normal year, we would have delivered a double-digit growth on that. Now we'll see how that turns out for a full-year basis. On a Q3 particularly, we have grown at 11% in illumination. That is about from 135 crores last year to about 150 crores this year Q3. That's a Q3 to Q3 comparison. Okay, but on a normal year, full-year basis, we should be topping 700 crores in that business going forward. And it used to be a loss-making business. This year, again, because of COVID impact, it may not be profitable, but next year it will be profitable.
Was it profitable in F20? Yeah.
No, it was not. So that's why that's one more turnaround business for us. Yeah. Had it not been for COVID, we would have been profitable this year itself.
Okay. And this business is largely ESL or this is also...
No, so ESL is very small, though we've got a recent order, which is why it's there. Otherwise, it's mostly non-ESL. And by Lume, we mean everything. It's outdoor lighting, it is stadium lighting, it is industrial lighting. A lot of the industrial lighting is private sector. It is metro, so DMRC is a client of ours. It's commercial lighting, so it's solar panel lighting. It's a mix of many different applications there.
Okay. Just one last question, Anuj. You've in the past indicated that about 10% margin on the consumer side in F23. Now, given that you've reported like back-to-back, 10% plus, and also indicating that this large part of this should sustain, is there a change in the stance on the 10%, or how should we understand that?
So Akshay, this is what you call the problem of plenty, right? What do you do when you're 2 years ahead of that target? And, in a way, that's a problem one has with the board also, right? Because they want more there.
Yeah, Anuj, you're still behind some of your peers, right?
I know, absolutely. So my point is yet, as management, of course, if you're ahead of that, we're not going to say that, okay, so let's sit tight for 2 years and not do anything. Our job remains to continue to improve and find those improvements. So that's all I can say. Will 12.3% sustain in the next quarter or not? How does it operating leverage, play out? We don't know. But in terms of, our own actions on cost, efficiencies, etc., we're committed to keep driving that. And not just, when I say cost efficiency, it's not only overheads, but including, our primary driver for, targeting improvements on margin was also our COGS or sourcing side efficiencies. So we will keep working on all of these things. And then my belief is always one way or the other, they come into the P&L. Only thing you cannot time when they will happen. But as long as you're doing the right things, I have every reason to believe that we will keep improving on this. Yeah. So if you're ahead of the curve on that, maybe you slip one quarter or not, I don't know. But we will keep improving on these things.
Great. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Hitesh Tang from ICICI Direct. Please go ahead.
Hello. Thank you for the opportunity, sir, and congratulations on a very good set of numbers. Sir, my question pertains to our gross margin. Sir, is it right to assume the price hike what you have taken from the Jan onwards, which is around 5 to 8% kind of thing, it is sufficient to cover the gross margin, or we can see kind of improvement going forward from the base? base quarter? This is my first question. And the second question is, sir, pertaining to our dealer addition, which has happened, 9 months vis-a-vis 9 months FY20. This is my second question. And third question, sir, what is your take on e-commerce front? It was earlier around 11 to 12 to 13% kind of contribution. Are we seeing kind of improvement on that side, or what is your take as far as increasing our revenue contribution from that segment or from that trade channel? Thank you, sir.
So, on your first question, which was price hike, a little early to say, but like I said earlier, my hope is that it should cover our cost side impact. But we always remember have to balance out price hike with the demand elasticity, judgment, and therefore that's why we try to balance that out. We will not want to protect margins at the cost of losing total sales and total profits. So somewhere there's a balancing act on that, but I would yet think for a large part we should be fine on that part. Okay, let's see how that judgment plays out. On the dealer additions, Mr. Purandare, you can give the exact number. We've had certain number of dealer additions or increases. That's because for some of the product categories we are looking at we appointed differentiated dealers and trying out some other concepts on that. So to that extent we've added dealers, but otherwise we are fairly covered in terms of dealer network size and reach, etc. Okay, Mr. Purandare, you have that number handy right now?
Yeah. So FY20 third quarter we had 501 distributors, which is increased to 530.
Sorry, 501 to 530, right?
Yeah.
Okay. And sir,
on the e-commerce question, if I may answer that, or the channels. So online continues to grow very aggressively for us. We've had a strong growth at about 79% on online business in this quarter. Share of business from online this quarter has been about 11%. It's not down versus the previous quarter because e-commerce is down, but the previous quarter you had some other channels that were very soft, and those have all come back. So it's really a function of that because all the channels are fired in this quarter. Only channel that is not firing for us right now is the government channel, which is primarily the canteen stores department and the police canteens here.
Okay. Sir, my last question, if I may ask, sir, what is the contribution of premium fan segment in our total fan category, sir?
I'm sorry, I didn't get the question.
Sir, we are going to focus on premium category of products going forward as per your comment.
Yeah.
And just wanted to know, what is the contribution of premium category of fans in our total fan revenue?
Okay, so we don't split that figure up, but to be honest, it is very low today. So we're not recognized for premium fans. We're recognized for sub-economy fans here. So it is very low right now.
Okay. So that's all from my side. Thank you very much.
Thank you, Hitesh.
Thank you. The next question is from the line of Manish Agarwal from Edelweiss. Please go ahead.
Hi, so first of all, congratulations on the sharp turnaround that we have been looking at, both in growth and margins. So, sir, firstly on the consumer business side, I know you have said that the margins are mostly sustainable on a long-term basis. You will not comment on the quarter part. But sir, there are headwinds, as you rightly mentioned, with the cost side and the season coming up. We will have some pickup from the dealers as well. Plus the ad expenses will go up in the Q4 as well. So, sir, in the near term, is it fair to assume that we might not be able to maintain maybe a 12% margins in the CV segment? And sir, the second question is on the EPC side. So, sir, you've given that that the absolute level of the business will remain same. Sir, any target mix between the three segments that we have that maybe the distribution has to be brought down to this particular level, maybe 2 to 3 years down the line? These are the two questions.
So on the cost side or the margin side, again, my macro answer remains that long term, and long term doesn't mean 5 years, but even over 1-2 years, we will work on continuing to expand the margins. Particular quarter, it's very hard to project and predict. It's a function of many things. But directionally, we will continue to expand our margins. And I do believe a lot of the measures that we've taken are sustainable and structured or structural changes that are here to stay. Okay, just a particular quarter, sometimes quarter to quarter, when we have some swings. My commentary at the end of Q2 also was that Q3 margins will be less than Q2, but fortunately Q3 margins are higher. So to that extent, I can be wrong positively or adversely, either which way. But otherwise, I'm not worried about it. In terms of EPC split, we do have an internal metric that we're targeting, but it's not fair for me to put that out externally in terms of the mix. But I think what's important for you is to understand that that metric is driven by capital turns and working capital turns and ROI on that capital. So if it meets that, then it should not matter what business we do. But if it doesn't meet that, we don't bid for things. So I think that's the more important metric that we're tracking for each of our sub segments in EPC also. And that's reflected in the order book that you're seeing, why it's taking a certain shape here.
Yes, definitely.
Thanks.
Thank you.
Thank you.
The next question is from the line of Sanjeev Goswami from Fractal Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. We have a couple of questions. The first question is with regards to the consumer product segment. Traditionally, our company has relied more on outsourced manufacturing as against some of our competitors who have preferred to invest in their own manufacturing. Now, historically, both the models have worked fine for both the types of companies. But of late, we are seeing that economic and regulatory environment seems to be building up. It seems to favor the domestic manufacturing as against outsourcing, especially imports. So keeping these things in mind, is there any change in strategy that we have from medium to long term in terms of looking at more of our own manufacturing?
So Sanjeev, if I may nuance what you're saying, I think government action is only on domestic versus imports, but there's no difference whether a third-party manufacturer makes for me domestically or I make internally. So I think clearly we are also working on greater indigenization and more local import substitution. That is already on. We've had some early success and some more that will happen over the next 1 year or so. Okay. That said, domestically, whether I manufacture myself or do it through a TPM, to me that's a function of capital allocation and whether setting up capex and manufacturing facilities is a good use of my capital, or can I just at a small margin pay out to a vendor, get the same product, same quality. So there, quite frankly, my thinking has not changed significantly. I think we have a certain model that is working for us. I do think the model that our competition uses is also working for them, so I have no complaints against that. But I don't see any regulatory or other change that is forcing me to change our sourcing model domestically. Only thing that we're changing is greater import substitution.
Can you give us some idea in terms of how much of our consumer products that we sell is manufactured and how much is imported and how much is domestically outsourced?
Mr. Purandre, can you share that number, please?
Give me a second. I'll do this.
So I'll just give a ballpark, because that varies, based on product categories and what's selling more at a point of time. But more than 85% is domestic and less than 15% is imported. Okay.
Yeah.
And similarly, our manufacturing internal versus external is almost a similar footprint. Only changes again happens month on month based on the volume of take of different SKUs.
If I may have one more question I had, actually that's on the EPC side. See, of the receivables that we have in the power distribution, can you give us some idea how much is receivable which is more than 6 months old? The idea is to find out how much receivables is because of the projects which are stalled or have been or are disputed.
Mr. Purandre? So, sorry, just to close the previous one, the numbers I've given you on sourced versus manufacturing and import domestic are correct. Okay, so that's fine. Mr. Purandre, on the receivables on power distribution.
See, receivables out of the 1,600 crores, almost 650 crores is the retention money. And as far as UP receivables are concerned, which I said 690 crores, most of them are more than 6 months because the billing has happened. Now, a lot of certifications and the other activities which are there for approving the payments which are there, well, there are these which are already approved and there for the payment. So, the majority of them are more than 6 months.
Okay. But most of the receivables is from the project which is still ongoing. It is not from the stalled project.
The projects are not stalled.
Okay.
These are at various stages.
Okay. Thanks a lot, sir.
Thank you.
Thank you. The next question is from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, just one data point. I just wanted to know what has been the operating cash flow generation for the 9 months.
It was 467 for 6 months and 142 now, right, Purandre? So just add that up.
Yeah.
Okay. Great.
Let me just confirm, but it should be 467 plus 142 if I'm right.
Wait a second, I'll just confirm that. Well, yeah, YTD 609.
And closing debtors, I mean, you mentioned for the EPC business it is 1,600 crores, but overall receivables would be how much, sir, as on December?
2208.
Overall receivables are 2,140.
Sorry, yeah, 2114. Consumer is 516.
Okay, great, sir. Thank you very much.
Thank you. The next question is from the line of Renu Baid from IIFL. Please go ahead.
So actually most of my questions are done. If you can just help me with the split of the order book that we have for the EPC business between the 3 sub-segments.
Yeah. Purandre?
Yeah. Transmission line tower is 388 crores. Power distribution is 501 crores. And illumination is 331 crores.
Sure. Thank you. So that's it from my side. Thank you.
Thank you. The next question is from the line of Rahul from Haitong. Please go ahead. Rahul.
Yeah, hi.
Go ahead, please.
Yeah, hi. Good evening.
Good evening, Rahul.
Yeah, it is very heartening to see such strong performance from the company. So many congratulations for this.
You had predicted it, Rahul, in your last report.
Yeah, I'm glad that things are shaping up the way we thought it would.
Yeah.
So that's great. So now most of my questions are also answered. A couple of things, maybe you can just touch upon. In the second quarter, you all had, guided for things like 3,000 crores of CP revenue. Going by your 9-month performance, I'm sure you're all set to beat that kind of number. And on the EPC side also, it looks like you're maybe falling short of the kind of number that you had put out, which was about 1,800 to 1,900 crore rupees. Do you want to touch upon these, both segments, the kind of number that you could do in this year, and how do you see this business going in the next year, given that you have 1,200 crore rupees of order backlog in the EPC?
So first on the CP guidance, Rahul, my point really was to touch last year's number on a full year basis. So do in 10 months this year what we did in 12 months last year. As we are currently positioned, for 9 months we made up for 9 months, right, despite not having those 2 months this year. So as long as we deliver growth in Q4, you will have an overall growth for the full year basis. I don't want to put a number out there on that right now, okay, but we do expect now to deliver a growth on a full year basis. On the EPC, unlike consumer, it is a far more lumpy, less linear, business based on new orders, sometimes execution issues, which do continue, including for illumination. So business may be perfectly fine, projects may be perfectly fine, but it doesn't move in a linear fashion. So sometimes it becomes hard to, split that up at a quarter level. So that's my only point. And therefore, yes, we are lower than our full year guidance numbers on that. But we make up for that at a bottom line level. So because it's project-based accounting, that doesn't really, hamper us so much. So we are more or less comfortable where we are with that. My only other comment I want to make is post the budget, which seems to be focused significantly on infrastructure spending and highways, etc. I would hope that some of that should also indirectly trigger into spending on, lighting solutions, etc. And therefore next year, give us a little boost on the EPC, particularly illumination business, maybe some amount of the transmission line business. That said, that is not going to take us away from our stated strategy of, yet being selective on the orders that we take. So as long as the pool is becoming larger and the total spending is becoming larger, that yet allows us to optimize our strategy of being selective, but being selective out of a larger pool, which is a win-win for us.
Okay, that is it. Thank you very much and all the best.
Thank you, Rahul.
Thank you. The next question is from the line of Darshan Engineer from Karma Capital. Please go ahead.
Yeah, good evening, sir. Congratulations for a great set of numbers.
Thank you,
I just had, thank you so much, sir. I just had one question. Sir, I mean, in our segmental reporting, normally we allocate the corporate expenses based on the sales breakup between consumer and EPC. So is it the case that because in earlier quarters you alluded to higher margins or lower margins in the respective segments to some bit of this mix between the two segments. So this 12.3% EBIT margin that has come in consumer durables, has some of it been also because of the much higher revenues in the consumer durables business? Or is it purely because of the operating leverage and other efficiencies that you talked about?
So if I get your point right, Darshan, but I think higher revenues and operating leverage is the same thing. In terms of allocation of cost, in fact, if I am allocating more cost to consumer, that would decrease my margin. But therefore,
exactly. So,
despite higher allocation of costs, which are in the proportion of revenues, these margins are despite that. So not inflated by that, but despite that. So which means it's a
it means that the
healthier position to be in.
So it means that inherent margins are actually even higher for consumer business than what is being reported right now.
Yes, if I compare that to historical trends 2 years ago, but quite frankly, as management, I would not want to feel happy about versus 2 years ago we are much better. Let's take this as a base, and I would yet want to improve on this, because it's never going to go back the other way around, where you will start seeing allocations move away from consumer. So improvements will have to happen and will happen further on this itself. So we are much better than we were 2 years ago, but rather than be complacent about that, I'd rather believe this is the base that we will improve on.
Sure. And my other question is on the R&D spend and the premiumization strategy. I remember 2 years back when we first started interacting with, at least I started interacting with you, I remember very distinctly that you had plans for a good R&D approach leading to a lot of new product innovation. But in between there was a slight shift in strategy to suggest that, the premiumization will be only to showcase that Bajaj Electricals also has premium products, but the mainstay will be your mass segment products. So if you can just throw some more clarity on how exactly will the R&D help in getting the premiumization strategy going, and so what kind of share should we expect from, say, the premium or the innovative product, and by innovation, what kind of innovations can we expect across your product portfolio?
So let me clarify all that I've said, and I think all of it is true. When I say premiumization, I'm not driven by being the absolute top premiumizer in terms of the most edgy products out there, okay? Some of that may happen for optical reasons, for demonstration. The current premiumization I spoke about today is just about, moving our brand and products slightly more aspirational, but not, losing sight of the fact that bulk of our business and scale and volumes will come from the median space or medium positioning, okay?
Right.
So it is not the very artificial, high-tech IoT kind of stuff. We will do some of that stuff. We've already done it. We have, IoT water heaters, etc. We will do that. But I just mean, better quality water heaters, not necessarily the IoT heater. So the difference in premium water heater versus an IoT heater, right?
Got it.
So that's the premiumization that will be more impactful than some of the absolute edgy premiumization, which is innovation. That will be more for brand rub-off and product rub-off. And therefore, in terms of a question on R&D spends or other elements, the way we're looking at that is to make sure that it's self-funded. So look at the brand spends, for example. This quarter, we've had a 1% expansion on, brand spends, 1 percentage point. But it's self-funded, so the margin does not get impacted because we've made sure that the overheads or the improvements more than make up for that. If you look at employee costs, we are continuing to be, very smart on employee costs over the last 1 year, etc.
Right.
We'll make sure that we will make, invest in the right lines or right cost lines, but also take out that money from the other cost lines that we need to take it out from.
Got it. Thank you so much, sir.
Thank
All
you.
the best for the future.
Thank you. Participants who would like to ask questions, please press star, then 1. The next question is from the line of Kunal Seth from B&K Securities. Please go ahead.
Yeah, hi. Sir, thank you for the opportunity. Most of my questions have been answered. Just one question on fans. you mentioned that, we are largely known as a mass market fan category player. So do we wish to increase our share in the premium fan, and are we, working anything towards those lines in terms of introducing new products, or, we are happy to be in the space we are in right now?
So let me start by saying we are a number 5 player in the fans category, and we do intend to grow that both in terms of rank, value, and volumes and share. And therefore, if we have to grow that, of course, we have to grow in the premium segment also, and therefore we will. And premium is a relative white space, like I mentioned in response to an earlier question. Therefore, we will, target to be that. But will we do that at the cost of losing our space in the existing sub-economy fans? No. So we will defend that and continue to do that. But in general, our trajectory will be slightly more upward skewing because that's where our gap is here.
Sure. Sir, and would it be possible to share what would be, share of premium fans in our total fans portfolio right now?
No, so we don't give that out, but it is very, very low right now.
Okay. Sure. Thank you so much, and best of luck for the future quarter, sir.
Thank you.
Thank you. The next question is from the line of Amit Mahawar from Edelweiss. Please go ahead.
Yeah, good evening, Anuj. I just have one question. What's our capital allocation strategy for the next 2-3 years? The kind of cash flow we are generating and we will in consumer PC in FY22-23. Where will most of the generation go? That's the only question I have. Thank you.
Thanks. Good evening, Amit, and thank you. So very valid question. We will make the right use of that capital. I think there's enough room for us to grow in our business, even inorganically, and deploy certain capital for that. If the question is alluding to, I meant organically, but if the question is alluding to inorganic growth, today we are pretty much, actively defocused from inorganic growth because I thought that would be a fiscal imprudence for us. If 2 years from now we have sufficient extra capital, and then we'll be a little more open to inorganic opportunities. But at the same time, I am personally very, very driven by it has to make financial sense on the P&L and not be driven by vanity. And typically, large-scale acquisitions are, hard to digest and, derive adequate value from. So just because we have extra capital, I would not want that to lead us into making any less considered, inorganic kind of use of that capital. So I think our capital will be sufficiently adequately employed organically, but we will be open to inorganic in a measured, evaluated manner.
Thanks, Anuj. I'll just ask one more question,
Sure.
Basis your answer. Maybe as your promise that you made to your board, the kind of execution you've delivered in last couple of quarters, it seems to be heartening. But do you think maybe 1 or 2 years down the line, given a seriousness in consumer business, it's far better than what investors maybe in the start, and that's reflecting in performance?
Sorry, Amit, your voice is cracking a little, so I got the first sentence.
Yeah. Can you hear me now? Yeah.
Yes.
Yeah. I'm saying basically, do you think in the next 1 to 2 years, board might think about, separating the two businesses because consumer is getting far bigger, far more opportunistic, and that was maybe 5 years ago. That case was a little weaker. But do you think we maybe in the next 2 to 3 years will head in that direction? I know this has been a question you've been facing for many years, and Mr. Bajaj for last decade and a half. But do you think we are heading towards that because the kind of growth we are sustaining might need a much better focus for both the businesses? I don't argue that the second business is not important, but do you think we are moving in that direction? That's my second question, Anuj. Thank you.
So, Amit, I know that's yours and everybody's favorite question. I have no answer but to tell you that's a speculative question. At the right time, we will do what we have to do. But irrespective, the one thing I want to tell you is that we will not suffer for lack of focus or bandwidth. And that I think we're demonstrating even now. As we clean that up, we're not, the process of cleanup of one side of the business is not, diluting our focus or ability to deliver on the consumer business. Yeah.
Okay, thank you.
Yeah.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Deepak Agarwal for closing comments. Please go ahead.
Thanks everyone for joining this call. Sir, any closing comment that you want to make?
So thank you all for joining in. I hope you are happy with the performance. As management, we're committed to doing what we can do and do it to the best of our abilities and keep delivering, execution. So our strategy we've laid out long ago, but, our commitment is to also execute to do that strategy and not stray from that course and keep delivering on operational excellence. Yeah, that's all. Thank you.
Thank you, sir.
Thank you very much, sir. Ladies and gentlemen, on behalf of PhillipCapital India Private Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.